All right, let's jump right into it. Welcome back to The Explainer. Today, we're looking at a company that's sitting at this absolutely wild crossroads as of Q1 2026. We're talking about Tesla, and right now, we're witnessing a massive high-stakes collision. On one hand, you've got some pretty sobering business fundamentals, but on the other, these wildly optimistic market charts and technical forecasts. So our goal today is simple. We're going to look directly at the data and figure out, is this company actually a viable long-term investment right now?
To figure that out, here's the roadmap for today. We're going to cover their core business and moats, management and their financial pivot, that massive intrinsic value disconnect, future catalysts, and finally wrap it up with an Elliott wave forecast.
Okay, part one, core business and deep moats.
Now, to really evaluate Tesla today, we've got to accept a fundamental reality. It is not just a car company anymore. Sure, auto revenue hit $16.2 billion, but energy storage and services, they are absolutely surging. Check out this massive number, 39.5%. That is Tesla's Q1 2026 energy storage gross margin. I mean, that literally blows the profitability of their automotive business right out of the water. Products like the Megapack, which target utility-scale energy storage, they're on this totally different, incredibly bright growth curve.
And honestly, this brilliantly shows why Tesla stays so resilient even when the auto market gets tough. They've built up these 5 undeniable, super hard-to-replicate strengths. We're talking total vertical integration, from the batteries all the way to the software, massive manufacturing scale with their gigafactories, dynamic data collection that's constantly feeding their full self-driving AI, complete ownership of the global supercharger network, and an unmatched brand premium. I mean, it's like a fortress. That is a remarkably deep competitive moat. Which brings us to part 2, management and their financial pivot. Because here's the thing, a great moat doesn't automatically mean a great investment, right? Elon Musk's management style is deeply baked into the DNA here. And if we break down the Q1 2026 reality, it's a real mixed bag of positive stabilization and, honestly, some looming threats. On the bright side, automotive margins bounced back to 21.1%, and they're sitting on a massive $44.7 billion net cash cushion. That's huge. But inventory days crept up to 27, which signals that auto demand might be softening. Plus, stock-based compensation hit $1.03 billion in a single quarter. That means existing shareholders are getting heavily diluted. And their capital allocation strategy? It is getting intense. The 2026 CapEx budget is over $25 billion. They are just pouring cash into AI infrastructure, robotics, in-house chips, the whole shebang. Because of this massive spend, management is actually expecting full-year 2026 free cash flow to turn negative. Honestly, for investors looking for high capital returns, that's a pretty major red flag. Tesla is basically operating with the all-in logic of a tech startup right now. They're heavily funding these high-uncertainty, long-term narratives instead of playing it safe like a mature company.
All right, moving to part 3, the intrinsic value disconnect. This right here is the absolute core of our financial analysis. There was this one quote from the source research that really hit the nail in the head for me. It said, investors buying today are not paying for proven cash flows, but prepaying in full for future stories that have not yet materialized. Wow. I mean, that forces a really tough question for your portfolio. Are you buying shares in a stable car manufacturer, or are you buying into a highly speculative story about robotaxis? Let's actually do the math on that prepayment. If we run a conservative 2-stage discounted cash flow model, and I'm talking one that factors in accelerated energy growth, positive free cash flow coming back in 2027, and hitting $45 billion in free cash flow by 2030, the intrinsic value of Tesla comes out to approximately $139 a share, but the stock is currently trading around $391. Think about that. The stock is trading at a staggering 180% premium to its fundamental intrinsic value. The market is basically already priced in the absolute most optimistic scenarios for the next 5 to 10 years.
So, part 4, future catalysts and trends.
You're probably wondering, what on earth is keeping that massive $1.47 trillion valuation alive? Well, it's a game of brewing catalysts. The market is desperately waiting for a few huge things to happen. They want the semi-truck to finally hit high-volume production. They want a real commercialization timeline for the Optimus robot. They need regulatory approvals for the cybercar, and they're looking for global grid upgrades to drive even more Megapack orders. But here's the catch, and it's a big one. These bets require absolutely perfect execution. Historically, Tesla delays timelines. That's just a fact. And when a stock is priced for perfection, any little execution hiccup could trigger a really sharp reality check. Finally, part 5, the Elliott wave technical forecast. Now, we are going to pivot sharply.
We just talked about that sobering fundamental intrinsic value of $139. But the technical analysis, it is telling a completely defiant story. Based on the supercycle degree 5-wave impulse structure, technical analysts are suggesting that the recent dip down to the $360 range, that was merely the end of wave 2. With the RSI sitting neutral and trading volume actually shrinking during that decline, which is a super bullish signal by the way, this model suggests Tesla is setting up for a massive technical rally.
And building on that wave structure, the forecast gets incredibly aggressive. If Wave 2 really is wrapping up, the model predicts a Wave 3 advance running from mid-2026 into early 2027. And get this, the target price zone is roughly $660. Ultimately, Wave 5 projects all the way out to the $860 range. I mean, that forecast completely ignores the fundamental intrinsic value disconnect we just talked about. It relies entirely on momentum and market psychology.
But hold on, we have to throw in a major caveat here. Our source explicitly warns that this is a highly volatile forecast. If the price breaks below that $270 support level, that completely invalidates this entire wave count structure. Technical analysis like this cannot exist in a vacuum. You absolutely must weigh it against the fundamental and macroeconomic realities of the company. Do not rely on Elliott wave theory alone, guys. So as we wrap up this explainer on whether Tesla is a viable long-term investment, we are basically left holding two completely different realities. On one hand, the sober financial math points to an intrinsic value of just $139. That's weighed down by negative free cash flow and a massive pivot into incredibly capital-intensive AI and robotics. But on the other hand, you've got this deeply entrenched technical trend and the promise of a sci-fi future pointing to price targets of $600 and way beyond. It's a company with incredibly deep, hard-to-replicate moats, for sure, but it is priced for absolute perfection in a really imperfect world. So, what do you think? Will Tesla's high-stakes narrative cash in or crash out? Think about how that all aligns with your own investment strategy. Thanks for hanging out, and I'll catch you in the next explainer.